Welcome everybody to the Ellsworth Advisors March monthly update. Today is April 3rd, 2020. I'm Kelly Kuennen, this is Cameron Miele, and we want to welcome everybody to the call today, or the video today. A couple things, obviously we're going through the COVID-19 virus crisis at this point in time. As a firm, just want to assure everybody that we here at Ellsworth, we continue to work on a daily basis. A few of us are working from the office. We are considered an essential service, and several of us are still working from our homes. If you do need to contact us, probably the easiest way is to contact us via cell phone, because whether we're in the office or at home, we may not be at our desk to get calls coming into the office. Going through this whole crisis emergency after 9/11, firms such as ours, we put in a lot of contingency plans. So, we hope we never had to use them, but we actually have used them, and we do have, off-site facilities. Our infrastructure from a technology standpoint is highly secure. We upgraded that in the last couple of years. So from a functionality standpoint, we've been able to do what we need to do. From a market standpoint, the equity markets have traded pretty much as planned, and have functioned properly. Bond markets have been a little rough, not as much liquidity out there in the bond world, which really has affected from a sell side. But we have been able to execute trades, actually have, in the trading we have done in the bond world from a sell standpoint, we've been able to get halfway decent pricing. On the buy side, a little different story. We're actually able to capitalize on weak pricing there. So in general, things are up and running. If you need anything from us, please reach out. We are, like I said, we continue to function on a normal basis. So as usual, we'll kind of start off with a little commentary from Cameron as to what's been going on in the economy, and then I'll kind of run down what's happening with the markets, what's happening with the portfolios, and kind of hit on some highlights as to what we've done since the beginning of the month and kind of our thought process moving forward. Cam, why don't you kick it off?
Thank you, Kelly. Good morning, everybody. Obviously, still, I think we've had to preface every video with these are unprecedented times, times that we've never seen before. And so there is really no economic update to give. We don't have any numbers yet. We don't have any figures. First quarter GDP should come out in the near future. These are our expectations. We expect first quarter GDP to show growth. That growth is going to be driven by January and February. March, obviously, the economy went into a virtual standstill. So I think first quarter, we're going to see growth, but that doesn't really matter today. It's our full expectation that we are in a recession, that GDP in the second quarter will be down, could be down as much as double digits. And depending on how quickly we can get past this pandemic and get the country unlocked, that will really dictate third and fourth quarter. But we will get through this. We're going to get through this together. And this is my fifth one of these market dislocations that I've seen, and this one is obviously unique. We were talking this morning, I think collectively the worst day in our country's history, modern history, was the terrorist attacks of September 11th. And I remember for 5 or 6 days just sitting in front of my TV, stunned. The world was on lockdown, nothing was happening. But on that Sunday following the terrorist attacks, we got an email from our department head, and he said, our office building is going to be open Monday morning. Everybody come back to work. It's the best thing we can do right now is try to move to some sense of normalcy, and it'll give good way to forget about things. And so Monday morning, we went back to work. The terrorist attacks and the ramifications were always in the back of my mind, but at least we were doing something. And slowly the world unlocked. I mean, we're sitting here right now in a virtual shutdown of the U.S. economy. And a $20 trillion economy doesn't turn on like a light switch. Now, thankfully, what's different about this and, say, September 11th or the financial crisis, in the financial crisis, you had the U.S. government pumping a lot of money into certain sectors. This situation is going to be unprecedented in terms of the amount of government spending that's going to happen. As many of our clients probably know, the Congress last week passed a $2.2 trillion relief package. That's really, by all accounts, just the tip of the iceberg. We could be seeing more than $10 trillion of economic recovery coming in the form of individual stimulus, corporate stimulus, massive bailouts to industries. I mean, entire industries, the auto sector, the airline sector, hospitality sector, travel, manufacturers of airline parts. I mean, all of these sectors are going to be reorganized and they're going to be different than what they were before. So the one nice thing is that the government has been responding. They've been responding aggressively, but we're going to see infrastructure projects in pork like we've never seen before. And hopefully aggressive slowdown, aggressive decline in the markets, quick government action. We move beyond this pandemic. Hopefully we'll see aggressive moves to the upside.
Just to add to that a little bit, like Cameron mentioned, in 08, 09, when there was a lot of government support, that the bulk of that did go into the financial industry, banks, insurance companies, and so forth. And there was definitely some political blowback there. We supported large institutions, which was needed to keep the financial system running smooth, but that was really the focus of the bulk of the dollars. And, those were mistakes made by the financial institutions. Right now, we came into this with very healthy banks, a very, healthy financial industry. And the key now, and where the key to the stimulus or the relief is that there's a lot going to the individual and small business owner. And my mindset is you need a little bit of support on the corporate arena, but not too much relief. Companies that have been misbehaving or maybe a little too stretched on aggressive activities, buybacks, and so forth, they may have to pay the price. And hey, they will be punished. But the reality is by supporting the consumer, supporting small businesses, healthy corporations, responsible corporations, those will be fine, because it's the consumer and small business that really drive the economy. And now that the focus is there with the relief, I think that's going to be key, and that's going to help smooth us out down the road. How long the recession lasts, I mean, obviously second quarter, hard to believe we won't be negative. It'll probably be a pretty deep negative. Third quarter, too soon to tell. Second quarter takes us into the end of June. So July, August, September. Could see some relief there, but very likely, third quarter will be negative. In my mind at this point, we'll probably see a positive fourth quarter, and it could be pretty good. Just depends on what the shape of coming out of this looks like. So let's talk about what we know has happened in the last month or so. Last month, the S&P 500 was down 12.51%. For the year, and this is all through March 31st, S&P was down 20%. The Dow Jones, down 20%. I'm going to caveat that the depth of the market really, at this point, the bottom was March 23rd. At that point, the S&P was down closer to 33%. So from March 23rd to the end of the month, we saw about a 12% rally. So in the last week or so, we're down slightly for this month, for the last couple of days, but we're only 2 days into it. The Dow Jones for the month was down 13.74. Year to date, down 23.2. On the international side, developed world, EAFE for the month was down 13.82, down 23.43 for the year, kind of in line with the Dow. Emerging markets took a bigger hit in March, down 18.41, year to date down 23.87. So that's how the markets finished up. Our portfolios for the month, growth with income portfolio really held up the best. We're down about 7% there, so that held up pretty well. Year to date, we're down about right around down 15%. Price potential, which is on the our growth portfolio for the month, down 14.3. So we definitely lagged the indexes. I still like our holdings there. We're a little bit more quality oriented. In the rally up, our stocks didn't participate as much. They definitely bounced off the lows. They hadn't gotten beaten down in that low point as much and just didn't have as much bounce back on the other side. We are seeing some divergence where it looks like some of the buying is being a little bit more selective, coming back on the upside, and we'll talk about that in a little bit in a few minutes. Year-to-date price potential down 21.36, so kind of right between the S&P and the Dow. Dividend yield for the month down about 11%. And year-to-date down about 18. So with our, basically highest quality dividend payers. They've felt the least pain. Obviously, year to date being down 18, that's held up really well. And then our small cap portfolio, with small cap stocks, obviously the most volatile, down 19.29 for the month. Year to date, down about 24%. So that's kind of a wrap up what's going on. Small caps, what happens there, because they're smaller issues, we did trading definitely thinned out. And when trading thins out, you have more buyers and sellers. You don't have as good bid offers, so that market doesn't run quite as smoothly. And through all this, we've continued to stick with our strategies, continue to make basically rotations within the portfolios. A few of the trades we've made, I'm not going to go through everything. Like in the price potential portfolio this month, early in the month, we sold UPS, bought Hormel. UPS still had a small gain for the month because we hold it in the dividend yield portfolio for the month. UPS is up, about 3.25. Hormel, that was still a decent trade. Hormel's up 8.77, so that was a good trade-off there. We did buy Costco, picked up about 1% there. We also bought Progressive, which is flat since we bought it. Got out of General Mills. That had held up pretty well. And more recently, we sold QSR, which is, basically a restaurant ownership that owns Burger King, Popeyes, and Tim Hortons. That continues to slide. We bought that last year, and I think it was just they have some issues there where, in a franchise model, you have risk beyond just the holding company. You have the risk with the franchisees and, the ability for franchisees to continue to pay leases and mortgages and so forth. So we've decided to step away from there. Dividend yield, probably the only move in dividend yield we made was we did step away from Boeing earlier in the month. So we got out before Boeing got too ugly. We bought Verizon. Verizon for the month is up about 3.6%, so that was a nice trade-off in there. Some of our winners in dividend yield, UPS, like I said, 3.25%. Merck was up 1%. Verizon was up, so nice gains there. In growth with income, CVS up about 0.25%. Gold was up a little bit. On the non-stock, I'm not going to go through a litany of downside. The market's definitely been crazy, and it's hard to really, are those prices real? I mean, it's just points in time. So, I'm not going to go through all the gainers and losers there. In the growth with income, we really haven't been, the only position we've had in bonds, we've had muni positions for our high income where that's made sense. Muni bonds have been a little bit rough this month, and that's really a function of a lot of liquidations that's been going on in the bond market. So with muni bonds, they've held up, but fortunately we've been more on the buy side there, so we've been able to get good pricing in the muni bond world. We're still buying quality bonds there. But we really don't have much corporate bond exposure. Where our bond exposure has been in Treasury bills, which basically have made small gains or are flat. More recently, and that's where I've been parking a lot of cash for clients over the last 12 months. One thing you will notice on your statements, where situation came up last week where the short-term Treasuries, T-bills that we had been buying, where we could get 1.4, 1.6, 1.8% just going out a couple months, basically those went negative. So one thing you may notice on your statements, a little higher cash positions where that money may have been in T-bills, but since rates went negative on T-bills, we're not going to buy, we're not going to pay to hold T-bills when we can just sit in cash and at least, maintain or get a really small coupon. So that's one thing to make note of, is there may be a little more cash in your accounts that wasn't T-bills just because the T-bill came due, and we did not want to reinvest at negative rates. I don't think that situation is going to stick around too long, but that could be a dynamic we see in April. Just hard to say how things transpire throughout this month. The other comment I want to make is, the virus situation, the downside in the economy, that's going to drag on for a couple months here. But the reality with the stock market will bottom long before the actual underlying crisis dissipates. Historically, you'll see anywhere from 3 to 6 months prior to the end of the underlying event where the market actually has bottom and starts trending upwards. So far the low we've seen was March 23rd. You lose that, you use that 6-month window. Okay, that takes us 6 months out from March. Okay, good chance a lot of normalcy will have returned by then. That potentially could be the low. Historically, through other major pullbacks like this, you typically see a low, get some recovery, get a lot of chop, and then good chance to revisit those lows. And then you finally get the final market recovery. That doesn't always happen. Typically it does happen. We didn't see that. It did not happen back at the end of 2018. So, can we count on it happening? It's hard to say. I mean, we can't get too aggressive, but one thing we can expect is the volatility to continue, the bigger swings. We're definitely off those lows. And in my mind, I think if we see a retest, we're going to see a retest probably as we get into the meat of earnings season, which will start in about a week or two. That's where, if we're going to see a retest, it'll probably be then. I expect volatility. And in general, through these weeks, we've been more buyers with new money coming in. Clients said, hey, I've had cash on the sidelines. I want to buy at these cheaper prices, which we are definitely proponents of, especially with a long-term time horizon. Inside the portfolios, it's been more rotating, upgrading our positions. In the growth with income portfolio, where at some point I will make a little more of a shift to the equity side, I'm kind of waiting over these next couple of weeks as we get into earnings season. I know the volatility has been there, and kind of picking our points as to what we want to buy. Have been getting calls from clients where they'll see a stock price that's way down. Do we want to buy it? And as a portfolio manager and looking at our clients, we have to have their best interests in mind. Up to this point, I've been a little hesitant to jump on, obviously the airlines are beaten down, cruise ships and so forth. It's hard to say what those are going to look like. And so far the approach has been, okay, if we liked it going in because of our quality bias, those are definitely the stocks we're going to continue to buy because they were solid going in. We know they're going to be solid coming out. So those are, higher probabilities of good recovery out versus kind of taking the lottery, trying to pick the lottery tickets, where to buy an airline right now, yeah, you're definitely buying at a cheap price, but that doesn't mean, if there's restructuring in there, we don't know what the real end result is going to be. And will there be capital restrictions? Will there be issues that can, basically limit the upside, or is there still more downside? There can still be more downside in some of these positions. I got a call from one of my wife's friends, not clients of ours, but, hey, I want to buy, should I buy Norwegian Cruise Lines? It's down to $10 a share, and, it's way down. Like, okay, it's down, but just because the price is down doesn't mean it's going to come back. They're not even U.S. taxpayers. There's legitimate reasons they may not even get any kind of bailout.
And it also,
is that really what we want to buy?
The new normal is, are 6,000 people going to want to congregate on a cruise ship anymore?
Exactly. So we're picking our spots. We want to, we know what we like from a quality standpoint, and that's always going to be more the safer bet. I'm going to lean more towards those, but there's definitely some areas that we're looking at to get exposure to the oil companies potentially in the next couple of weeks. Yes, that's probably the easiest example. And then going back to some of the stocks that we haven't held because of valuation, those may be some that we start to revisit now that things have been repriced. So we went into this with a market that was probably overvalued. We're going to come out of it where everything has been knocked down. There's still going to be stocks that are overvalued that we may shy away from, but there will be some good values in there. And just adding to what we have has made the most sense, up to this point. What plays out over the next couple of weeks through earnings season, some new opportunities are going to come up, and we will have some rotation within our portfolios is really how we're looking at it. Big picture, talking about liquidity, with new dollars coming in. Obviously, if your job's in jeopardy, or if your hours have been cut, or if your income has been reduced, having as much cash on hand as possible is important to make sure you cover your cash flows moving forward. A lot of our clients are retired, and it's more kind of business as usual, where we've had liquid dollars to cover distributions. So I'm not as concerned there because, hey, we're kind of waiting for something like this to happen. So we're in pretty good shape providing liquidity. The equity side of the portfolio will ultimately come back and be in good shape. You want to add anything, Cam?
No, I think we've taken up enough of our clients' time.
Yes, we have.
Thank you very much. We appreciate your trust. I do know that we're always looking out for your best interest, working hard every day. So on behalf of Kelly, just want to say thank you very much for your trust. If you have any questions, please feel free to give us a call.
Thank you, and look forward to talking to you in the coming weeks.